Hey, it's Keith Akati here over at the Mortgage Reel. Happy holidays to you and yours. Thank you very much for being my client and allowing me to assist you with the financing process of your home. And to honor you, I wanted to share some information from an economic forecast that I recently attended. And what's the crystal ball saying about our future, the recession, our hyperlocal market, as far as where our value is going to be and what's the future hold for us, right? So let's dig in. Here's a slide deck that I received from a recent economic forecast presented by MBS Highway to all of Fairway as our company. And it really helps break down what's been happening with the recession and how it's going to impact interest rates. So one of the Fed's favorite measures of inflation is the core consumer price index. And the best way, easiest way to think about this is they take December of this year and compare it to December of last year. What was the cost of the goods the consumers are using when they strip out some of the fuel and energy costs? What do they look at and how much the consumer is paying for everything? Well, if you look at the beginning of 2021 and all things past that going into 2020, inflation didn't exist. We're running at hardly any inflation. And then it really started to pick up, as you can see, going through summer and then coming into the beginning of this year. So, of course, when you're comparing the same month of the previous year and the current month, and that inflation is higher, that's what pushed things up so much. And the cost of goods of everything that we're paying for kept on the increase. How the Feds combat inflation is they have used the Fed rate hikes to slow inflation down. So when you hear the Fed is hiking interest rates, what the media has notoriously failed to educate us as the consumers, because those same people, the media can't balance their own checkbooks. That's my joke, by the way. I'm sorry if there's anyone from media listening. But here, this chart simply shows that each one of these gray bars is the length of period of time of a recession. This goes all the way back to 1955. And as you can see, all throughout history, as those federal rate hikes happen, when we get to the peak of those hikes, causes a recession. So right now, the Feds are trying to slow the economy down and inflation down. So how they're doing that is hiking the short-term rates. Now, keep in mind, you're going to hear it this month again in December, probably again in January and February, the Feds are going to hike the rate again. What those Fed rate hikes impact are your short-term overnight borrowing rates for loans and credit, is such as car loans, credit cards, installment loans, student loans, and also how the commercial world borrows. So again, Fed rate hikes, here's the dot-com bust, here's the Great Recession, and then here's the COVID recession. So as you can see, Fed rate hike, recession, Fed rate hike, recession. Now, what does this have to do with mortgage rates, Keith? Well, if you look here, when you look at the mortgage rates, which is this white line, and again, the gray bar is the recession, here's the dot-com bust, the Great Recession, COVID recession. And all throughout history, you can see that as we enter into recession, the mortgage rates do pressure lower. Mortgage rates pressure lower. And of course, we experienced what happened in 2020 when COVID hit. Those were the lowest rates in U.S. history. On the flip side, housing. What happens with housing values? Well, you can see going back to the 60s here, and again, these gray bars are the recessions. Anytime we've had a recession, you could see that housing, with the exception of the bad lending practices and everything that went on in the Great Recession, in all of the previous recessions, including the COVID recession, housing began to, in values, increase and have appreciation during the recession. Now, why is that? I can say right now that I am sitting on the sidelines and amazed and eager and excited about being able to witness and experience history in the making, is because when you have a period of time where you have the lowest interest rates during COVID recession, and then literally within 18 months, 18 months or less, that interest rate went from the high twos and tripled and went into the mid sevens, right? So now all of a sudden the housing market has stalled and the housing prices are coming down. Well, let's talk about interest rates going back down. So if that's causing housing to cool, we go into recession, and now interest rates do start to decrease, because here's that pattern of mortgage rates decreasing. This is why during a recession, you see the housing values starting to show appreciation. So now the question comes into when. Next, you're going to hear some information that's being presented by Barry Habib, who is the founder of MBS Highway. I have followed Barry now for close to over a decade and a half, and he definitely breaks down everything that happens in the financial market and how it impacts housing and the bond market as far as mortgage rates. He's been incredibly accurate over the years, and he continues to call the crystal ball almost to the day. So we're going to hear from him on what's actually happening as of right now with data that was just released and that's going to be coming, and how that's impacting interest rates. And then I'll come back to close this out.
Now, you might remember November 10th. That's the date we had told you about months in advance to circle. Well, December 13th may not have as big of a response, but it should be another indicator that inflation is coming down on an annual basis. We're going to replace numbers for November of 2021 with likely a lower number. So year over year should come off that 6.3 on the core inflation report, and the headline should come down too, maybe even more dramatically. So we will watch those carefully. Remember, we told you about that quirk, that anomaly in the shelter costs for that lodging outside a home, which was up a whopping 5% for the month. And that thing reads like crazy. So maybe if that comes back down to normal, we get a little added boost here. It might have been a good thing that didn't kind of give us the oomph we needed, because the market was already on fire. So this might be something we've got in our back pocket that could help us this month see a little extra juice on Tuesday with that CPI number. Look, things can change, things can unfold, but we're feeling pretty optimistic about it. And then you go to Wednesday, right? So Tuesday and Wednesday is the Fed meeting. So clearly at the Fed meeting, they're going to be all sitting together, and they're going to see this lower CPI number, we think, the lower PPI number. You got a lower PCE number. They've got to start to wake up and smell a little coffee. Somebody's got to give them some extra strength, espressos or something, to say, hey, inflation's coming down, okay? So maybe they might have just a little bit less of a harsh tone, a little bit more of a dovish tone. They're not going to go overboard. They're still going to hike 50. They're not going to say, oh, everything. They're going to be cautious, but maybe they're not looking to pound the table like they have been, and the markets will pick up on that sea change. And you could get a good day in the markets on Wednesday as well.
So that's Barry Habib, someone who I listen to on a daily basis. And you can tell he gets excitable at times, but it helps because it keeps us in tune with what's happening with the market and what we really have to pay attention to. And the biggest factor right now is what's happening with the economy, the data that's impacting all of us for the goods that we pay for, and how that's aligning with inflation and now starting to come down. And when you see that easing, that's one piece, right? When you spoke of the 50 basis points, again, that impacts your credit cards, auto loans, student loans, and also the commercial borrowing side. So for the mortgages, it does pressure the rates lower. So we're anticipating that when the Feds do hike that 50 basis points, that it's going to help to ease the interest rates on the long term. Now, it's not like a 1% drop, but it's the first steps to pressure these rates lower, because we have had a significant run up and almost tripling the rate from the all-time lows that we saw in 2021. So I know you're waiting for it, the punchline. What's going to happen with rates? As of right now, interest rates are sitting in the mid 6% range. In 2023, as you can see on this slide, interest rates are anticipated to hit the mid 5% range. When is that supposed to happen? Right now, the crystal ball shows sometime in the first quarter, potentially going into the second quarter. Forecasting a little bit further down the road into 2024, they anticipate that those rates are going to hit the mid 4% range. So that's what's going to spur housing. But here we have the challenge of housing. As you can see in this slide, it reads in the headlines as of September 16, 2021, the housing market is short more than 5 million homes. How did that happen? You have to go back to the Great Recession. In the Great Recession in 2007 to 2010, basically in that time frame, you decimated builders. Builders left the space. They went bankrupt. They said, I'm not even going to touch real estate anymore. We never recovered from that. So we have been chasing new construction the whole time, and the buyer side has been outpacing the builder market. Plus, you take areas like our local market of Seattle, King, Pierce, and Snohomish County, there's not a lot of land left to develop. So that's why you see every time an older home is sold, if it's purchased by a developer, they're redeveloping it and turning it into new townhomes, or they're building multifamily. So in order to gain perspective of new construction catching up to meet the demand of the buyers, you can see here on this slide the Mortgage Bankers Association forecast. And again, these numbers are in the thousands. When you look at 21 through 25, for single family homes for 2021 is at 1,131. Again, these are in the thousands, so you multiply it by the thousands, right? For 22, it was at 1,027. Then you see the decrease down to 1,011 and 23, and slightly go back up in 24 and 25. This isn't enough increase yet to still keep up with the buyer's demand. Plus, one of the things that's really not talked about is a lot of people have fallen in love with their interest rate. During 2020 and 2021, interest rates were 3.5% or lower. If you look at those same owners that think about buying today and increasing that interest rate by double and also having to pay more for a house but not getting that much more, well, I have to say it myself. I've fallen in love with my mortgage payment, so I'm falling in love even more today with my house, right? So that puts even more pressure on the seller side, and the buyers are still there. We still have so many multiple buyer situations for every home on the market. You know, again, today it's not pressuring the house price higher, but you still have multiple buyers. Even though they're waiting on the sideline, waiting to see what's happening with prices, when the house gets priced right, we are seeing multiple buyers. So in closing, where does this lead us? We really have to pay attention to who's the next generation of buyers. In this slide, you can see the average age is between 28 and 38. That's this yellow representation here. It's the biggest buyer population. And if you compare this to the baby boomers, the new buyers generation of this age demographic, which are millennials, outpace the baby boomers. Even though baby boomers are the largest holders of real estate, when you compare with where the baby boomers were in wealth at that time when they were starting to buy versus the millennials today, the millennials are more affluent in income. I do want to pass on this sentiment. I'm a true optimist, and this is a global recession. It may not feel good if you know someone or have experienced layoffs due to the unemployment pressures, but we will come out of this. And it is something that with housing, when you look at the crystal ball of housing, after each recession, housing values do go back up. And in this recession, as rates lower and you bring all these buyers back with a limited amount of inventory, it is repeating from history that the housing market is going to lead the U.S. economy back out of the recession as everything starts to improve. So have that in faith in home ownership. It's one of the things that you can always count on that's going to help build wealth in your portfolio. Thank you very much for allowing me to be part of your housing experience and journey, and we'll talk to you soon. Merry Christmas and happy holidays.